partner with someone that has done a deal of that scope.
What would be some of the things that are factored into the expense ratio that make some properties more expensive to manage?
Property taxes are the largest line item on a P&L.
How does somebody go about figuring out an actual expense ratio when you're entering a new market?
Ask experienced investors and ask large property management companies.
Hi, everybody. This is Jose Luis Morales. Welcome back to the Residual Real Estate Agent Show. This is episode number 102. Today, we've got a very special guest. His name is Axel Ragnarsson. He is a founder of Align Real Estate Partners, which has done over $27 million worth of real estate deals and now owned multi-units in a couple of different states, valued over $28 million in real estate. He is also the host of the Multifamily Wealth podcast. Welcome to the show, Axel. How are you?
I'm doing great. Thanks for having me.
Thank you. Thank you. I'm excited about having you on the show. Just to start off, who is Axel? How did you get started in real estate?
Yeah, absolutely. So the quick backstory is born and raised in Southern New Hampshire. Went to school in New Hampshire, went to college in New Hampshire, had a bit of an entrepreneurial upbringing. My parents were entrepreneurs themselves. They actually started and ran a company that sold wood chippers. So very different than real estate, but I was exposed to business ownership at an early age, which was great. So, bought and sold things my whole childhood instead of having a job and, Xboxes, electronics, cars, bikes, whatever. I was buying and selling stuff. And got into college and was trying to figure out how I could make a little bit more money on the side than what I was doing, which was buying and selling cars at the time. And I think I literally Googled, what do people flip to make a lot of money or something like that? And found out about real estate, flipping houses, and started learning about real estate investing through Bigger Pockets and some other websites. And, while I got into the business because I wanted to flip houses, through education, I discovered rental real estate and multifamily real estate, and just this whole world of passive income. And that really spoke to me. And I think that was, at the time, it was a really interesting concept to me that you could kind of do the work once, buy a property once, put the work in to find the deal and close it, but then get paid in perpetuity. And so I kind of shifted my strategy away from trying to flip houses. And then I started buying multifamily properties in college, smaller multifamilies, 2 to 4 unit deals. And that was about 6 years ago. And, for the first 4 years, organically building a portfolio that replaced my income, kind of gave me a salary to live off of, paid my rent. And during that time, I moved down to Boston and started getting a little bit more serious about the business in terms of looking for larger deals, 20, 30, 40 plus unit properties, and expanding into some other markets as well. And really in the last couple of years, the business has shifted to one that raises capital from investors who want to invest in multifamily properties, but don't want to go through the headache of finding the deal and putting it together and managing tenants and all of that. We basically partner with those individuals to invest in our deals. And now we buy large multifamily properties in New Hampshire, Central Florida, and Indianapolis are big markets, although we've done some deals in other cities. But really just started out just doing my own deals with my own money, and snowballed to the point to where some investors wanted to come along for the ride, and we started doing some larger deals. But that's the high level, I guess, the spark notes.
That's awesome. Take us back to the very first deal that you ever did. How old were you, and what type of property was it? Was it like a single family, a multi-unit?
So it was a 3-unit deal. It was actually in my hometown in Chester, New Hampshire, which is a town in Southern New Hampshire, very small town. People listening to this that live in New Hampshire probably won't even know Chester. But it was a deal that I found on Craigslist. So it was a for sale by owner, and seller just, old landlord, wanted to get out of it. And I actually put that one together with private money with a private investor. So it was somebody that I met through a couple of networking groups that I was in. And, I was just really hustling to find somebody that would lend me money. So put that one together, direct to seller, financed it with private money. And basically I owned that one for about 9 months before I sold it. And just, again, snowballed from there. That first deal leads to the second, the third, the fourth in pretty rapid succession, oftentimes, if you're looking for them. And that kind of got the portfolio going.
That's awesome. And then it sounds like at the beginning you were flipping some properties. And then at what point did you actually come to the realization that wealth or long-term wealth is built through rentals, and then also that you can continue to get paid in perpetuity to the deal.
Yeah, absolutely. So that was the first real estate deal I did, was that 3 unit. And, I kind of wanted to shift my focus away from flipping houses, despite the fact that that's kind of what got me interested in real estate, was that whole concept that you can, buy a property for 200 grand, put 50 in and sell it for 300 or whatever. But at the same time, I was still networking with wholesalers and, real estate agents, and going direct to seller to find these smaller multifamily deals. And eventually, there were some single families that came through the pipeline. So I did flip a couple of properties. I sucked at it. I was terrible at it, awful at managing contractors. I was awful at just, basically being a project manager. And at the same time, I was getting away from self-managing my rentals. I think I had like 5 or 6 units when I flipped my first house. And by that time, I was already sick of self-managing tenants. So I handed that off to third-party management. And I quickly realized I wanted nothing to do with the operations in terms of the day-to-day. All I wanted to do was, find deals, finance deals, raise money, and, be involved in the operations at an asset management level, not discussing, day-to-day stuff with tenants and dealing with that stuff. So lost a ton of money on the second house I flipped, a ton of money. And it was a deal that went wrong in 5,000 ways. And at that time I was like, dude, this is not for me. Like, this is just doesn't align with my skill set, doesn't align with what I enjoy about real estate, isn't why I got into the business, which is to build passive income, and completely shifted my strategy to multifamily only. And that's where I really started to excel.
You mind me asking some of the ways that the deal went wrong, maybe just so our viewers can kind of learn from that, or maybe things not to do? Obviously, it was a huge lesson for you, and it was a very important pivot in your business. Would you be open to sharing a little bit about that?
Yeah, of course. And, I think we learn way more from our failures, right, than our successes, especially as it relates to real estate deals. So there was really a couple of things that went wrong with that one. The first and most significant thing was I just hired the wrong contractor. So I bought it right. It was a foreclosure property that I bought at auction. Buy price was right. I still look back and say I bought it right, and my estimation of the renovations were correct, and my sale price was on point. But where it went wrong was I lived an hour away from the property, so I couldn't check on it really on a daily basis, or else it would have taken over my life. So I was really only going up there once a week to check on the project, and I trusted my GC a little bit too much. His subcontractors were terrible. He was he's someone that I'd worked with on apartment turnovers previously, so I thought I had a good rapport with him. But turns out he just wasn't a great guy. Stole some of the deposits. His subcontractors were stealing materials, just little enough to where I didn't really notice. His work was subpar, so we had to do a lot of work over again. So there was a million reasons why he wasn't the great guy to work with. And the simple takeaway is work with great people, right? Overpay good contractors, because that's just going to make your life a lot easier. And on top of it all, the second guy that I hired, which came highly I was so mindful, I'm not going to make this mistake again. The second guy that I hired, which was recommended to me by a few house flippers that I knew that were doing high volume, he ended up being terrible as well. And he bit off way more than he could chew. So he was basically trying to do 5 jobs at once with a crew that could only really handle 2. So he was only on site a couple of days a week. He was only sending one guy to really work. And that guy wasn't being supervised by the GC. I wasn't there enough to supervise. And really, between them, basically just 2 bad contractors who were basically doing each other's work over again. And on top of that, the timeline stretched out significantly. And basically, time is money in real estate, especially when you have high interest debt and you're trying to flip a property, you're trying to turn around a multifamily. Like, you got to act quickly. Speed is just as important as your renovation costs. So it was supposed to be a 9-month project because it was a really big turnaround. Ended up taking 18 months. So I just had 9 additional months of interest just out the door every day, or every month, I should say. And, between all of that, we went way over budget. The project went way over timeline. And it was just too big of a project for me. It was, I bit off way more than I could chew myself in terms of how far away this deal was and how big the scope of the work was. It was something that I had never done before in terms of, it was $150,000 renovation. It was much beyond anything I'd ever managed. And going through 2 contractors, you're gonna lose a lot of money if you ever get in a situation where you have to fire your contractor and start over. So, the takeaways for the listeners are, vet people, like, really, really vet folks and work with people that are highly recommended and manage them at a micro level that first time you're working with them, which is something I didn't do. And if you're going to take a step up and do either a bigger house flip than you've ever done, or do a bigger multifamily project than you've ever done, you should probably partner with someone that has done a deal of that scope if you haven't done it before, to reduce your risk, right? And so that you can learn from somebody else, which I didn't do. So those are a couple of the big things I think I learned on that one.
It's funny, Axel, because of the very first property that I ever flipped, I bought it right, I sold it right, but the contractor just took way too long, and I actually over renovated the property for the neighborhood, meaning I invested a lot more than what the neighborhood was willing to pay. So I took a potential profit of this to this. And at that point, I thought to myself, man, if I would have just kept that property now, that property would be worth like 3 times what I ended up paying for it. So how does somebody vet a vendor? Like, obviously you check references. Do you check work that they've done? What would be ways of somebody actually vetting a contractor? Because that seems to be like probably one of the most important things, working with the right people. Are there any rules of thumbs that you use, any screening processes that you recommend for viewers?
Yeah, absolutely. So for any vendor, whether it's a real estate broker, a contractor, a property management company, an insurance broker, anyone, right? I think where I start is with getting referrals, which is funny because the story I just told, that guy was referred to me, right? But I didn't do the second level of vetting. But I like to start with getting referrals from people that are way ahead of me and way more successful, much smarter than I am. Ask them who they're using, and then those are the people that I want to talk to. I never really start with like a Google search, right? I think, you're leaving too much to chance by Googling, real estate brokers, New Hampshire, right? You're going to get such a wild variance of results there that it's not even going to be that helpful. So I think you want to go network your butt off and get in touch with all of the folks that are in your market, in your niche, ask them for referrals. That's step one. Then once you have those referrals, I always ask for references from current clients and past clients. Mm-hmm. So current clients, for example, with a property management company, they might be someone that they've worked with for a month, and they might be, they might have had a good experience so far, but maybe this property manager really puts on a good show the first month that they work with a client, or this contractor really does great for the first 6 weeks of a job or something, but they start to tail off, or they start to slack the longer that they've been working with a client. So that's why I ask current, folks, because I want to get the current perspective. But I also ask, have you worked with anyone in the past, right? This could be someone where a contractor's done a job and been paid and is no longer on that job. I want to speak with that client, right? Because they're going to give me the full picture. Mm-hmm. If it's a property management company, which I keep coming back to as an example, who's someone that you manage a property for that ended up selling or leaving for another management company. I'd like to speak with them, because then they're going to give you, again, the full scope, the full picture, the true, the full and honest truth. So really, those are how I vet folks now. And, again, I just have a lot of screening questions. How do you work, for example, for a contractor? It's like, how big is your crew? Who do you subcontract to? Because that's as important as who the GC is. How many jobs are you working on right now? And is this going to stretch you too thin to where you're not going to be able to give enough attention to this job? And then once you get through all of those screening questions, those are just a few, you want an ironclad contract. So something that I didn't do early on with contractors, or some other service providers, but contractors are really the main one here, is have a very, very detailed scope of work, a very detailed contract that says, okay, this is the extremely detailed scope of work, like down to these are the light switches that we're putting into this, this remodel. This is the exact timeline that we agreed to. If you don't get it done in this timeline, for every week it takes you longer to do it, the final payment is reduced by 10%, 15%, something like that. And you set the expectation up front, like, I will hold you to this. This is a binding agreement, because contractors, again, they'll get into it. My brother got, married, and I went to so-and-so for a week or whatever. And you're like, all right, well, now we're a week behind, and that week is going to cost me, the investor, $2,000 in hard money costs, or private money costs, or whatever. You have to be insanely diligent with setting expectations up front, because the more you do that, the less it gets confused on the back end. So, that's really how I've gone about screening folks.
That's awesome. That's great advice for everybody. So when you made the pivot in your business where you made the pivot to large multifamily deals and obviously taking on investors as well too, what did your strategy become at that point? Like what was your new strategy at that point? And what does a typical deal look like for you now?
Yeah, so I think it was the reason I made the change is I wanted to keep growing. I could have kept doing 2 to 10 unit multifamily deals, which is what I did for about 4 years with my own money. And that's fine. I was making money and building the portfolio and everything was going well. But for me, I was like, I want to just do larger deals. Like that was a personal fulfillment component to what I wanted to do. And at the same time, there is an element of scale that you achieve with larger multifamily that makes really just doing those deals really enticing. So, for example, it takes the same amount of time to close a 6 unit property as it does a 60 unit property. It's the same amount of work. And actually it's easier to do a larger deal because the debt side is much easier and the financing is much easier and it's easier to raise capital for a large deal. Once you get away from personal guarantees and small local banks and you start working with more institutional level lenders, that whole side of the business gets easier. From a property management perspective, or I should say an asset management perspective, which is the role of the general partner, the investor, same amount of work. You're going to have a call every couple of weeks with your property manager, whether it's a 6 unit deal or a 60 unit deal. Maybe that call is a little bit longer, but it's not 10 times as long, right? Mm-hmm. So for me, there's an element of scale that you achieve there. It was a personal fulfillment for me. And I just saw more opportunity at that level, right? So obviously there's more money to be made when the numbers are larger, which is a big thing for me. And the other piece of it was I had a lot of folks in my network that wanted to come along for the ride here and invest with our business and invest in our deals. But for me, it didn't really make sense to bring in investor money or to partner with other folks on deals that were small because I didn't really need to do that. And it just overcomplicated the whole thing. So I was like, I have these folks that want to invest. I have these folks that want to partner. Let's go look for larger deals to put that money to work to establish some of these partnerships. And that's what we did. And the first step in doing that was doing some large deals in New Hampshire where we started doing some portfolios. We did a 24-unit portfolio, a 27-unit portfolio, a 40-unit portfolio of a bunch of smaller multis. Mm-hmm. Went down to Florida, Central Florida, did a 16-unit down there, a 28-unit. And that was kind of our first foray into working with investors and doing slightly larger deals. And now we're really looking for, 50, 60 plus unit deals, that have a value add component where we can go in there, raise rents, manage more effectively, increase the operational efficiencies and create value for our investors. And I'll still do smaller deals on my own too. Like I'll still go buy a 5-unit deal up in New Hampshire with my own money. But we're actively pursuing some of the larger deals just because that's where we want the business to I guess, focus and to move forward to.
Yeah. How do you select an area as to where to go? I know that you said Central Florida. Like, how did that come about?
So it's funny because I spent so long trying to find markets. And I think that's where a lot of investors get stuck in the analysis paralysis. If they want to go outside of their local area, there's like a million markets you could look in. And for me, you got Charlotte, North Carolina, you got Chattanooga, Tennessee, and Huntsville, Alabama, and Jacksonville, Florida, and you can just go crazy looking in different cities. So for me, I was like, all right, I got to pick 2, and I just have to go deep, right? Because if you spread yourself too thin, you're only going to build average connections with everyone in those markets. Mm-hmm. So I said, I got to go pick a couple. I got to go really deep. I got to build great relationships with the people operating in those markets. So obviously, everyone knows Florida is a hot area. I wanted to look in Florida, but in an area of Florida that wasn't completely overly competitive. So, the coastal markets like Tampa, St. Petersburg, Miami, Fort Lauderdale, Jacksonville, those are very competitive cities in terms of trying to buy. Mm-hmm. So we started looking in Lakeland, Florida, which is a city of about 110,000 people that sits right between Tampa and Orlando in Central Florida. And for me, I was like, this is a great market. There's great population growth, great job growth, a lot of income growth and rent growth, all these metrics that we like to see. And it's one that I can actually compete in. Like being a guy, because I live up in Boston, right? I'm never going to compete with the local investors in Tampa unless I'm just working my butt off. So to gain traction in a market like Tampa as an outsider is incredibly challenging because you're competing with all the local folks and you're competing with everyone across the entire country. But you look at a market like Lakeland, I'm competing with the local folks. I'm probably competing with some people throughout Florida, but I'm not competing with investors from New York City or LA, right? So there's just less buyer competition, and it's a market where there's more mom and pop owners. It's a little bit more of an inefficient marketplace. So I wanted to focus on an area where great fundamentals, but it's a place that I can actually compete in. So I'm not just wasting my time. So that was Lakeland. And the other market that we started buying is Indianapolis, which is a little bit more well-known at a national level.
Mm-hmm.
But again, I'm not competing with as many folks in a lot of the top 10 markets like a Tampa or a Phoenix or Houston or Dallas, Austin, all these cities that everyone's familiar with. So I wanted to compete. I wanted to be able to go direct to seller and find good deals. And I wanted the market to be one that was growing and had good long-term, prospect.
Did you have friends in Lakeland, Florida, or anything like that? Because even that's one of the issues that I'm having. Like I own a lot of, or not a lot. I owned 57 units in Southern California. It's about $12 million worth of real estate. Eventually, I want to go out of state, but part of it is like, where do I go? And I know that it has to do with population growth, and I know it has to do with job growth as well too. And what you're saying is making sense about avoiding some of the larger markets where you're competing against big time players. Like what made Lakeland, Florida, or how did you end up there? Like, did you start off with a larger list? Did you look at rents? Did you look at prices? Is there anything else that you looked at?
Yeah, I looked at a lot of the cities in Florida, and I asked myself, all right, because you're right, it's everything becomes so much easier if you know people that are there, especially people in real estate that are there that are familiar with the market. So for me, I was looking at some of the coastal cities up in between Jacksonville and Fort Lauderdale, and there was a few cities there that were pretty competitive, like West Palm Beach, Daytona Beach, which we're actually doing a deal in Daytona Beach right now, but I was looking in those markets because they had the good demographics. The price points were very similar to what I was familiar with up in New Hampshire. So I was like, it's, not a big learning curve, but I didn't know anyone there. So it was really challenging to get familiar and to feel comfortable. So what I did was I joined a lot of networking groups that I knew had a lot of folks in Florida within the groups. So I met a couple of guys that lived in Tampa through one of these groups. And, again, Lakeland's about 40 minutes outside of Tampa. They owned some property in some cities that bordered Lakeland. They didn't have anything in Lakeland yet, but had some in surrounding areas. And I basically said, hey, I'm going to go hunting for deals. If I find something, I'd love to partner with you guys. Maybe you guys can help with the asset management, kind of spearhead the boots on the ground stuff. I'll help put together the money, and, we'll slice the deal up according to what makes everybody happy. So those first two deals, that's what I did. I partnered with those guys, and, a lot of limited partners, and we raised capital from investors. But they've been extremely helpful in the asset management of the property. So, checking on the property every couple of weeks, holding the property management company accountable, keeping the pulse on the local market a little bit more so than what I'm able to do from afar. So that was helpful. Although at the same time, that just made me feel comfortable, right? I probably could have done those deals from afar and still been, they still would have went okay, but it made the decision a lot easier and made me feel a lot more comfortable putting money to work when I knew I had people down there that were close. So I think what you've described is really important. I think people get so hung up on the metrics, like the numbers, right? And at some point you're just going to be in an area that's growing, right? Mm-hmm. South Carolina is just growing as a state. Florida as a state is growing. Texas, Arizona, all these places are just growing. So you're going to be fine no matter where you're at in the state, most likely. And then, you want to make sure you're not buying in a really bad neighborhood. So you do your due diligence at that level, and connecting with local agents, local property managers can help you vet that. And then after you close a deal, it becomes a lot easier if you have a really, really good property management company or a partner down there that can just help you manage whatever management company you're working with. So I do think it's good to almost work backwards from where people if you just want to gain traction pretty quickly.
That's great advice. I love the fact that you found somebody as well too in those areas, and you didn't mind slicing the pie accordingly to be able to almost like hedge a little bit of the risk. What does a typical deal look like for you now? Like, let's just pick, or maybe you can give us some perspective from Indianapolis to Lakeland, Florida. Like, for example, like price per unit, cap rates that you're buying at, average rent per unit, and then what the rents are after you stabilize the building and after you get them up to market value.
Yeah, absolutely. So I'll use, basically we bought 44 units in Lakeland from two different sellers that were,
Mm-hmm.
you know, 0.25 miles apart, quarter mile apart, very close to each other. We bought them like 9 months ago, and I looked at the numbers we paid, and it's insane. They were great deals, but basically the model is, we want to buy at X dollars per unit, put Y in, and we want it to be worth 15-20% more than what we're all in for. And that creates great value for us, creates great value for our investors. These deals, we really significantly outperformed that. We paid about 65 a door for both those, put roughly 8 to 9 grand a door in. One of them we have even less in. One of the buildings is 16 unit, and they're going to be worth 110, 120 a door when we sell in 6 months or so. And that model is very similar to what we like to do, maybe not at that extreme of a discount at that level, but buy it 70 to 90 a door, put 10 a door in, and then have it be worth 115 to 130 a door, and create value there. So I'm very much a believer in that you make your money in real estate through creating value and through building equity, not really through cash flow. Cash flow is great. We all want to, we all want the passive income. We got to pay our debt service. We got to do all that, but that's not going to like really move the needle for you in the long term. You really make money in real estate by being all into a project at 2.5 million and it's being worth 3.25. Like it takes you forever to earn that money through cash flow. So we like to get into deals where the going in cap rate, I don't even really look at it. We've bought deals that were cash flow negative day one, right? And you couldn't even put a cap rate analysis on it because it would have been a negative cap rate or a 2% cap rate or something like that.
Yeah.
But because we're buying at 70 a door and the rents are 700 a month, and we know we can get them to 1250 a month with 8 to 9, grand a unit, we know we're creating so much value there that when we sell or if we refi, that's where we're really earning our return and making our money and making our investors happy. So, I long story short, I don't necessarily use cap rate too much on the going in side. I really care about price per door, reno per door, and closing costs per door, because I want my all in per door cost. And then I compare that to what's it going to be worth on the back end if we get the rents to this number, and we operate at this expense ratio, and then I apply a cap rate on the stabilized side to get to kind of the stabilized value. But I got to see a spread there. That's really the big thing for me. And, if we see something that looks compelling, then we'll get into an Excel sheet and start to do the IRRs and the, average annual returns and everything like that. But that's kind of the back of the napkin I use on every deal going in. I'm like, what are we looking at per door? How much is it going to cost per door to get to the stabilized rents? And once those rents are that, what's it going to be worth per door? I think that's really the simplified version of it.
Does the 1% rule apply to large apartment complexes at all?
That's a really good question. So it depends on the market. I think that it can be a really good back of the napkin underwriting tool. If I'm looking in Central Florida and the asking price, let's say, is 100,000 a door, current rents are like 800 and it's 0.8% per door. And I know that maybe the stabilized rents are only going to be like 1,050. And I'm going to be above the 1% rule with my purchase price per door, my renovation cost per door. I'll probably just throw that deal away or give some quick feedback because I already know that it's not worth getting that in an Excel sheet. It's not going to pencil out. So it can be a quick analysis tool in that respect. However, in more core markets, like if I was looking at a deal in Boston, I would dive all over a deal if it hit the 0.7% rule, right? Because the cap rates are so low that if you buy something at, in my neighborhood, it's 500,000 a unit. If you were to buy 15 unit deal, or that's tough math. If you were to buy a 10 unit deal at 500 grand and the rents are, 3,500 a unit, but you can get them to 4,500, that's a really compelling deal, even though it doesn't meet the 1% rule because the cap rate's like 3%. So when we go to sell it or refinance it, the value per door might be $750 a unit or something like that. So it really depends on your market, I would say, is the short answer to that. And, maybe Central Florida around 100K a unit is kind of like that's kind of where maybe it starts to make a little bit less sense.
Are there any rule of thumbs that you use to underwrite deals? Like I know that when I was learning to underwrite deals, I went to an event and they said, whatever the gross rents, use like a 40% or even a 50% expense ratio, and then divide that by your NOI. And then that would give you a price that you can pay for it. Are there any rules of thumbs that you use? What are your thoughts on that?
That's a good question. I think using an expense ratio is actually really helpful. So I agree with that, high level logic for sure. It depends on market, depends on class of property. Indianapolis C-class deal, it's going to run at a 50% expense ratio.
Mm-hmm.
Every single broker package is going to say 35%, 38%, 30, 40%. And it's just not a reality. Like it just isn't, and I look at so many deals that I get sent from partners, and I'm like, dude, I got the data. Like the data says that these run at 50% rate, 50% expense ratio. If it's a C-class area, if it's built in the 60s, if it fits this rough box, that's just what it's going to cost to run the deal. So yeah, if you want to get your stabilized value, take your stabilized rents, and multiply it over a year, get your annual income, divide that by 2, divide that by the cap rate in the market that you think it'll be in a couple of years, and that's going to be your stabilized value. And then you can start to back in what you can pay, off of that number. And that's how I do the back of the napkin is like, if it's 100 units, $1,000 a door, you're gonna get a 100,000 a month in income, 1.2 million a year. Multiply that or divide that by 2. You're at 600K in NOI. Divide that by a cap rate. There's your stabilized value, right? And now you know what you're working towards. So now you got to go figure out, all right, if I'm putting this amount per door in and I'm paying this amount per door, am I above that number? Am I below that number? What's the difference between those two numbers? And then you can start to see if it's a deal worth pursuing. But that is the one rule of thumb that I think is helpful, is the expense ratio for sure. Because once you know what that is in your market, it makes underwriting deals so much easier and so much faster. Because the one thing that you want to do if you're getting really active is you need to be able to work through deals quickly. There's just not enough time in the day to go take every deal you're sent and spend an hour in Excel playing with the numbers. Like that's not a good use of your time. So I think if you can nail that down, I think that's going to be really helpful. And it's different in every market and different for every class for sure.
How do I go about finding out like what it is for every market? I know that for you said you had the data already, but it's so funny because the broker packages are going to say the lowest expense ratio possible. And all that could possibly mean is that there's a lot of deferred maintenance or stuff that's not getting done, or it's being fluffed up a little bit. So how does somebody go about figuring out like an actual expense ratio when you're entering a new market?
Ask experienced investors and ask large property management companies. Those are going to be the two best answers for you. We have property management company, or property management, I should say, in-house up in New Hampshire. And we also do third parties. So we have a lot of data. We get all this data from our properties, our clients' properties, and we look at it and we run deals at a 48 to 50% expense ratio in our C-class deals in central Manchester, New Hampshire. Like we have a ton of data that supports that. If an investor called me and was like, hey man, I want to buy in New Hampshire, what's the expense ratio for a 10-unit deal in Manchester? I'd be like 48 to 51%. Like that's just what it's going to be. And unless you're self-managing or you're personally GCing projects or any of those different things, that's what you're going to run your property at if you're running it like an investor should, which is third-party management. You're not managing, you're not buying your own materials or something like that. That's just what it's going to run. So, the short answer is just ask the folks that own a lot of property in your target market and make sure that the way they run their business is the same way you run yours. Make sure that they're not like vertically integrated and, have a lower management cost, or make sure they're not self-managing. Make sure that they're, that their rents are that they're running the property similar to how you would, and then, use that information to help build out your own assumptions. But again, I think that there is a bottom to this, right? Like if I'm buying A-class properties in Boston, Massachusetts, and downtown Boston, beautiful views, my expense ratios are still going to be at least like 35%. Like it will never be lower than that ever. So, I think that there's always a floor to this, no matter what you're looking at. I know the most successful operators that run these large class A, beautiful, 2019, 2020 built properties, 48% class A. And it's just, so it's never going to be below a certain number. I think if you ever start underwriting something below like 40%, I think you're just being irresponsible at the end of the day, unless you have some really compelling reason to why that would be the case. So I would always work back to 45 to 55, depending on class, depending on age, depending on market. But again, the short answer to your question, because I'm rambling to an extent here, is just go ask the property management companies, the experienced investors, and the folks that are playing in your market.
Now, this may be a little bit of a newbie question, but when I was looking, when I bought my 25 unit apartment and I started asking around like expense ratios, people started throwing out like numbers like 40 and 50%. And I would think, I'm like, there's no way on a smaller property, I have a 40 to 50% expense ratio. For like the newbies out there, like what would be some of the things that are factored into the expense ratio that make some properties more expensive to manage? And I think you already covered one of them, that like a newer property is going to have a lower expense ratio versus an older property, but also maybe things like weather, I would imagine, like things that are market specific. Do you mind kind of maybe things to look out for in certain types of markets that maybe you wouldn't know unless you live there?
Yeah, absolutely.
Or you own property there?
For sure. Yeah. So property taxes are the largest line item on a P&L. So if you're in a state with high property taxes, that's something that you want to look out for and understand at least how that reflects on a P&L. So for example, New Hampshire, I believe, has the third highest property taxes in the country, whereas I can't remember what the lowest. I think it might be Hawaii is the lowest. Funny enough, it's like a tenth of the property taxes in New Hampshire. It's much, much lower. So understand how that reflects itself in a purchase area and a profit and loss statement, especially if you're looking in different markets. Weather, you mentioned, is a big one. For example, in New England, we have snow removal costs. You might not have that in Florida. You might have lawn care costs, might be a little bit lower than your snow care up in New England. So understand how weather plays into that. But the biggest things are typically age of property, tenant class, and really the construction of the building. Like a brick building is going to have a lower ongoing maintenance spend than a building that's like a wood frame building or something like that, or something that has a flat roof versus a pitched roof. A flat roof is going to, especially if you're in the Northeast, it's going to collect snow. Snow is going to melt on your roof. You're going to have more ongoing maintenance and capex costs to manage a roof like that versus one that's pitched and doesn't have those problems. And tenant class is a huge one. You're going to have higher vacancy in your C class buildings than your A class. That's going to come into play. You're going to have higher turnover costs in your C class than your A class. You're going to have higher bad debt, basically more collections issues in your C class than your B class, and then your A class. So understanding how class of tenant plays into the expense ratio is pretty important. And then, yeah, like you mentioned, age of property is a big one, especially if there's no common areas. So if you have an apartment building that has common hallways, or it's got a common amenities area like a dog park or something like that, or a swimming pool, there's all these cleaning costs and maintenance costs associated with those versus a townhome community where there's literally no common areas. You just walk right into your apartment when you park in front of your apartment. That's going to have a lower expense ratio than one where you got to go clean the common areas twice a month, and you got to clean the office space or the mailbox area or the coin-op laundry area. So I kind of threw I guess a few different things at you there, but I would say if you were going to put them in order of the most significant, it's state in terms of property taxes and ongoing weather related maintenance costs. Tenant class is huge. Age of building construction and type of building construction, whether there's common areas, type of framing construction, all that fun stuff.
That's awesome. How does somebody go about finding deals in other markets? I know that you said that you decided to focus on a couple markets versus a lot of markets because you wanted to build relationships with people. Who are the people that you're looking to build relationships with, and why?
Investors down there that have complementary needs to what I can bring. So, for example, when I went down to Florida, the guys I partnered with were looking for someone who could, help qualify for the debt, who could help raise money and bring money, who had operational experience, and I could help with all those things, right? So do an audit on what you're good at and what you're able to bring to the table as a partner. If you're someone that can raise a lot of money or you just have a lot of money yourself, look for deal finders that need help with that. If you're a really good deal finder, look for people that have money in that market. Maybe you come from a background of house flipping or wholesaling, and you have a really good skill set as it relates to going direct to seller. Start marketing in your target market, and understand that once you find a deal, you're going to go bring it to a partner that you've networked with who's got money and can help you with the operations. So understand what you have to offer, and then go find people that need that, because the easiest way to go into a new market is to partner with somebody else. Because that just magnifies your deal flow in a lot of different ways. The other thing is you want to go down there and you want to talk to brokers, especially the larger the deals you're pursuing, the more important brokers are going to be to getting deals done. We've done a lot of deals direct to seller, a lot of 10 to 70 unit deals. We've done a good chunk of those direct to seller with just direct mail, cold calling, all of that. But the effectiveness of that completely falls off a cliff once we start getting to 80, 90, 100 plus unit buildings. The owners are way more sophisticated. Oftentimes it's ownership groups, and it's not like just a guy who bought it 20 years ago. It's a couple of partners that are a little bit more tuned into what's going on. Brokers are much more plugged into that community than a lot of the smaller deals. They spend much more time cultivating the relationships with these large owners. So for those, direct to sell is not going to work. If I want to do deals at that size, I need to go become best friends with the brokers. So what I would recommend is go get a free CRM of some kind, like a HubSpot or a Zoho or one of these free CRMs, and build out a contact list of partners that you can work with, other investors, deal finders of any kind, wholesalers, property managers, any other service providers. Build a cadence to stay in touch with these people, and then do the same thing with brokers, but like stay in touch with the brokers at a way more consistent basis. And understand, just be honest with yourself and understand where you fall in the food chain. If you haven't done a deal and you're going into a new market, you're probably not going to get a deal from a broker, and understand that. Your first deal might have to be a direct to seller, might have to be a partner with someone that's got some deal flow down there, and you start, you get your name on a deal, start to build your resume. And once that happens, then you can go to the brokers and say, hey, I own this, I've closed this. And your efforts in trying to build relationships with brokers are going to be a little bit more effective. So my advice to everyone is don't just go straight to brokers and expect to find deal flow. If you haven't done a deal, in that market, I would say it's much better to really try and generate direct to seller business, or, go and work with folks that need your help in some way, and give up some of the deal to just get something done, because then it makes finding more in the future way easier.
It's funny, Axel. Before I bought my first big building, I would reach out to commercial brokers, letting them know that I was in the market. And then after I bought my first big or 25 unit, they all started reaching out to me afterwards. It's almost like now they're like, okay, this guy's a serious buyer. And shortly after that, I bought like an 11 unit right after that. But it was almost like I got in their buyer list at the moment. How did any struggles during the pandemic with rent collection? How did some of the buildings perform? What's some advice that maybe you can give to people or landlords out there when dealing with this?
Yeah, we faced some challenges. It really wasn't as challenging as I would have thought when COVID first hit. I think I was a little bit more nervous, in April of 2020 than I was, later in that year. And a big reason was that we have great management companies. Our own management company is great up in New Hampshire, and we work with great management companies in these other markets that we buy deals in. And they're constantly over commuting with tenants and basically saying, if you're having problems, come to us. We'll refer you to the related government programs that might be able to assist you. We can help you find a new place, or a place that's a little bit less expensive if, your hours got cut as a result of, some of the impacts that COVID had. And I think that the people that struggled during the COVID times were folks that either didn't have enough reserves to even deal with any blip in the market, which is a lot of folks. A lot of people were just all gas, no brakes. Like, anytime money's coming into my account, I'm throwing into a new deal, and they didn't have, sufficient reserves to manage properties in the interim there. And the other folks that struggled were people that just didn't have great management companies and didn't communicate well with tenants, didn't work with tenants the right way to keep them in the units, right? I think in multifamily real estate, there's no one more important in your team than your management company. That's the most important. They are going to dictate your success in a deal. Even if the last couple of years the market's just been shooting straight up, you can get away with sloppy operations to an extent, but when the market starts to flyline, or it's not appreciating as quickly. Operations is what separates the great investors from the average ones. And so we really focused on that. And the other piece that helped, which is just a reality, is the government stepped in and was just throwing money at tenants. So, up in New Hampshire, the New Hampshire Fund, Southern New Hampshire Services is the name of the program in New Hampshire. And they, a lot of states have their own version of this. There was so much money sitting in that account that was earmarked as relief for tenants that wasn't getting used, that we just tapped into that. Said, hey, you're having trouble. You're in the service industry. Your restaurant shut down. Here's the exact steps you need to take to go apply for this relief, to go get some of this relief. And we were just really proactive in helping folks understand what was available to them. But, I'm not going to pretend like the government wasn't helping everybody out that was in multifamily real estate. So I think there's a few things, but I think, operations are key, focusing on that, having some reserves and, understanding what's available to you and to your tenants.
I agree. It's funny because when things are good, everybody's doing well. But when things aren't as good, that's really where you kind of see who's doing things right. And I think the best thing you said there is just over communicate with people and be aware of all the government assistance programs that are available out there as well too. How do you slice? I know that you talked about slicing a deal or making an operator a portion of that deal. I know that you also mentioned at some point that you've done like joint venture deals. What would be just an example? It doesn't have to be one that you have done, but for those maybe looking to partner with somebody in a different market, what would be like a reasonable piece of the pie to give? Obviously, it depends on the value that they're bringing. But can you give us an example of a way that maybe a deal was structured?
Sure. So I'll give an example of a syndication deal because I think it's a little bit more easy to illustrate the overall economics of it versus a joint venture, which can vary pretty wildly depending on who's doing what. But let's say in a typical syndication structure, for example, in 2022, when we're recording this in February, there's some kind of preferred return, 7-8% that you pay to your limited partners. Those are the people that write you a check and have nothing to do with the deal. They're just funding it and they want passive income, passive cash flow. And they, they're not involved in the operations at all. And there's some kind of equity split above and beyond that. So you pay your first 8% to your LPs. And then above that, you're paying 70% of the proceeds to your LPs and 30% is going to the general partners, who are the people finding, running, and basically operating the deal. So oftentimes you take that 30% GP stake and slice it up amongst a few different people if the deal is large enough to support this. Oftentimes a third of that 30% is allocated to folks who are, raising money for the deal or something like that. So, if you have one individual who's raising capital for the deal and that's really their role in the partnership, they're going to take 30% of the general partnership, maybe 10% of the deal once you do that math. A third of that or so, 33%. Another 33% is typically dedicated to whoever's operating the deal. This is the person that's on the phone every couple of weeks with the management company. Maybe they're traveling to the property once a month, a couple times a month, in the beginning to make sure construction's moving along, to make sure things are, happening quickly, to make sure everything's on track. And then that other 33%, other third of that general partnership can go to, the deal finders. If there's like a deal finder that is finding the deal and they're not involved in the asset management, they just, found the deal and they want them to, have some equity and maybe they own half of that. The other half could be someone who's signing on the debt, who's helping to qualify for the debt. The KP is what this person is known as, the key principal. They're typically someone who's got a big balance sheet, who's, got a nice net worth, and they help qualify for the debt for the whole general partnership. That's like a very vague, rough situation, but that's kind of somewhat constant across the industry. But, for example, you might have one person who does multiple of those things. You might have the asset managers are also the deal finders. They're also the KPs, the key principals. They might own 50, 60, 70% of the general partnership, and they bring in a partner to help them raise the money for the deal. And that person owns 30% of the general partnership. Or they raise half the money and they own the majority of the general partnership, and they just got a partner that's coming in to help them, raise half the money or something like that. But usually you got a third to capital, third to asset management, a third to anyone who's doing the other stuff, signing on the debt, who, finding the deal, what have you, right? And there's any number of ways to slice it up. But Usually that's how I've seen it structured, but I'm hesitant to say that's kind of normal because it's such a wide variety of structures and splits at the end of the day.
That's awesome, man. Good. Axel, any final thoughts for our viewers or anything else that you like to share?
Final thoughts. I don't necessarily have any. I think for me, a big thing for me this last year, and this is kind of what comes to mind here, is I've really focused on pushing the edge of what I've been doing. It took me forever to get out of doing deals in my local market with my own money, and I so badly wish I had grown faster sooner because I had the knowledge and the skill set to do so. I was just held back by the limiting belief stuff of, yeah, I'm nervous about working with other people's money, or I'm nervous about doing larger deals. And I think that's something that might be beneficial to folks listening is if you want to make a next step, whether it's multifamily real estate or you want to flip larger homes, or you want to do you want to take the next step in whatever vertical of the business you're in, you should think about the opportunity cost of not doing that, which is often just time you're wasting because it's likely you have everything you need to do that. And if you're nervous about it, go find somebody who's doing it and partner with them on whatever you're doing, whether it's flipping a larger home or whether it's expanding into a new market to go buy multifamily real estate, or it's buying a larger, multifamily property. Go find the folks that are doing it and partner with them. And that's going to accelerate your growth pretty significantly because it just removes that barrier, which is what holds a lot of people back from growing in their business. And that's something that I've been doing with a lot of people that are quote unquote the rung on the ladder below where I'm at. If you find a big deal, bring it to me. I'll help you close it. And I also do that with bigger deals. I take my big deals, I take it to whoever's above me and I say, I got this deal. I want to make sure that we deliver for our investors. I want to make sure that I don't miss anything on this deal. I would love to partner with you on it. How can we make that happen? So at every level, there's people below you that you can help and that you can partner with. And there's also people above you that you can help and partner with. So I would say be open to partnerships and understand that you can grow a little bit more quickly than you probably think if you embrace that.
I agree. It's funny. I have a friend that was talking to a guy that owns like 300 million of real estate. And he's like, yeah, I want to buy a 100 unit in my career or something. He's like, why don't you just buy them now? And taught him a way to raise capital and if you're talking to the right people, there's always ways of making things happen. Where can people find you?
Yeah, absolutely. So really active on Instagram at Multifamily Wealth. I host the Multifamily Wealth podcast, which if you search it on iTunes or Spotify, it should come up. If you want to send me an email, Axel, AXEL at alignedrep.com. And if you're someone that's thinking about investing passively or want to learn more about that strategy, head to alignedrep.com. And we have plenty of downloadable resources that talk about that strategy. You can get on our email list. But those are all great ways, long story short.
Awesome. For all of our viewers, if you've enjoyed today's episode, make sure to subscribe. If you feel like this episode will be beneficial to anybody, make sure to share this episode with them. For those of you that are new to our channel, we have an episode every single week. This was episode number 102. We had Axel Ragnarsson in today's show. We appreciate your time and thank you so much for tuning in.
Absolutely. Thanks for having me.